Unlocking Tax Obligations, a guide to non-resident rental income in Canada. Canada is known for its attractive real estate market, attracting many investors globally. Non-residents who own rental properties in Canada are subject to specific tax requirements. Understanding the regulations surrounding non-resident rental income is crucial for compliance and avoiding potential penalties. One key aspect of this tax regime is Section 216 tax, which imposes obligations on non-resident property owners. Let's delve into the details of non-resident rental income tax requirements for Canada. Non-resident rental income in Canada. Non-residents who earn rental income from properties located in Canada are required to report this income to the Canada Revenue Agency, CRA. This includes individuals, corporations, and trusts that do not reside in Canada but earn rental income from Canadian properties. The taxation of non-resident rental income is governed by the Income Tax Act and relevant regulations. Section 216 tax. One of the key provisions that non-resident property owners need to be aware of is Section 216 tax. This section of the Income Tax Act outlines the tax obligations for non-residents who earn rental income from Canadian properties. Under Section 216, non-residents must file a Canadian tax return reporting their rental income, expenses, and any withholding taxes paid. Calculating tax liability. Non-resident property owners are required to calculate their tax liability on their net rental income derived from Canadian properties. This entails deducting eligible expenses related to the rental property, such as property taxes, insurance, maintenance costs, and property management fees from the gross rental income. The net income is then subject to Canadian income tax at the applicable rates. Withholding tax. In addition to reporting rental income through a tax return, non-resident property owners may also be subject to withholding tax on their rental income. By default, tenants are required to withhold and remit 25% of the gross rental income to the CRA on behalf of the non-resident landlord. However, under certain tax treaties, the withholding tax rate may be reduced, providing relief to non-resident property owners. Compliance and penalties. Non-resident property owners must ensure compliance with Canadian tax laws regarding rental income. Failure to report rental income, file tax returns, or pay taxes can result in penalties and interest charges imposed by the CRA. It is essential to maintain accurate records of rental income and expenses to facilitate tax compliance and avoid potential issues with tax authorities. Seeking professional advice. Navigating the complexities of non-resident rental income tax requirements in Canada can be challenging. It is advisable for non-resident property owners to seek guidance from tax professionals or accountants with expertise in Canadian tax laws. Professional advice can help ensure compliance with tax obligations, optimize tax efficiency, and mitigate any potential risks or penalties. Conclusion. In conclusion, non-resident rental income tax requirements for Canada are governed by specific regulations, including Section 216 tax. Non-resident property owners must fulfill their tax obligations by reporting rental income, calculating tax liability, and complying with withholding tax rules. Understanding and adhering to these requirements is essential for maintaining compliance with Canadian tax laws and avoiding any penal consequences. By staying informed and seeking professional advice when needed, non-resident property owners can navigate the Canadian tax landscape effectively. Need help navigating Section 216 tax rules? Call 416-283-8774 or visit theaccountingandtax.com.